a lot of these things happening right now, if you want to say are out of their control, which, for the most part, they are. I mean, insurance costs, we have a deal. This is a real example. Insurance went from $600,000 a year on a deal to $3.6 million in 1 year. Totally serious.
Wow.
Totally
Holy
serious.
cow. Whoa.
So we told the lender there's no way we can, that's not going to happen. So
Tim is one of the most authentic and genuine people I've ever met.
I sincerely believe he's coming from a position of giving, and that means a lot.
You're going to make huge progress.
Welcome everybody to today's capital raising show. I'm your host Tim Mai, and today I have an amazing guest speaker on the line with us, Mr. Mark Kenney. Mark has a lot of fans. I don't know if you know this, Mark, but whenever we do these shows, we promote, we advertise who we're interviewing on my Facebook wall, and you have a ton of comments of people like just love you and speak very highly of you. So I'm super happy to be able to interview you today. And Mark is a seasoned real estate investor. He's been doing this for over 25 years now. He's a two-time best-selling author and co-founder of Think Multifamily. He got into this business as a side hustle while he was working his 80 plus hours a week in the corporate world. And since then, Mark and his team has purchased over 18,000 units, totaling over $1.5 billion in assets across 14 states. Those numbers are just like mind-blowing, Mark. Yes, Mark has a desire to help others to learn, to get started and go bigger with apartment investing. And Mark is a graduate at the Michigan State University in accounting and is a CPA. He also provided IT consulting for over 20 years, leverages his vast IT experience to bring new and creative technologies that will help others in the multifamily space. Mark has worked for organizations such as KPMG Consulting, EDS, SAP, HP. He founded Simplifying IT, which is an IT services to Fortune 500 companies. And with that, let's give Mark a big Zoom welcome, y'all. I'm super excited to have you here, Mark. Thank you so much for doing this interview with me today. Let's start out. If you can share with us, what is it that got you into this real estate investing to begin with while you were working your full-time job?
Buying small multifamily when I was in college. So I was a senior in college 30 years ago. And I think it was really more of a function, nobody in my family was buying or anything like that, but I have an identical twin brother. And we were both kind of, of the opinion that people need a place to live. Didn't really know much about the stock market, didn't really like the stock market that much. So I started buying small multifamily then. And then, as you mentioned, I was a CPA for a while, did IT consulting, had an IT firm, and continued to buy small properties. In 2013, invested initially passively in a couple of deals, multifamily deals, and then started syndicating shortly after that. And really the main reason I started syndicating was my IT business was doing pretty well overall, at least I thought it was. But the amount of stress and hours I was working and things like that and travel, it caused a lot of issues, family time. And my wife, Tamil, was kind of the opinion I needed to find something else to do. So that's what drove me to start looking more seriously at syndication, because I figured if I was going to buy, the 2 to 4 units we were buying every few years, I'm going to run out of time in order to make enough to sustain the lifestyle we had with the IT business.
Gotcha. Okay. And then, so you've been in this market for a long time. You've been through 20-something years. So you've been through, I guess this would be your second cycle. Is that correct? Or maybe
it is. When we owned smaller properties before, and it was not syndication back then, but this one's a little different in my mind currently.
Gotcha. And then when did you start your education business, Think Multifamily?
We started 2017.
Okay. So not that,
relatively speaking, now we started the Think Multifamily in 16 and started the actual, if you want to say, coaching, mentoring in 2017.
Gotcha. Okay. So you spent, around 20 years building up your business. And so what got you interested in the education side?
Actually, I had zero interest in the education side initially, and it's true. Both my wife and I didn't have an interest in it. Really, through some circumstances, we were part of a group that at least we felt probably could have done things a little differently, and we had some people ask us to, try to do something on our own, and we didn't want to. But we started out initially doing webinars and then meetups and then half-day event, full-day event, and kind of just turned into a full-scale mentoring business. But it really wasn't something that we, really sought out to do initially. Kind of happened and then just kept growing, basically.
I see. Very cool. Yeah. Sometimes things just work out organically that way, right? It's just a big need, and we're here as problem solvers. We just go and fulfill on these needs. So share with us, one of your first big raises that like one that you had a lot of challenges. Ideally, like one that's earlier on in your syndication career here. Do you have a deal in mind that you can share with us?
Yeah, I probably have a lot of deals in mind, unfortunately. But the first deal I ever did, I would say, was probably the hardest from a mental standpoint. Background, as you already mentioned, IT guy, CPA typically doesn't lend itself to trying to raise capital and things like that. It was. And we never talked about money, like growing up. My parents never talked about money. I didn't even know how much my dad made. Just, money was kind of a weird thing to discuss with other people. Mm-hmm. But we got a deal, and I did have a partner, fortunately, that was more experienced at the time and had the balance sheet to qualify for the loan. But he really didn't participate much on the capital side. So it was something that I kind of really ended up kind of taking on that project. But I was very nervous, very scared. And you're under a time slot, right? You have to close by X or something will happen. You lose your earnest money or whatever it might be. But there's no question mentally that first one. Now I've had a number of other ones that have been much larger raises that have been, a struggle. If you want to say, we've always found a way to kind of get through that. But that first one was a struggle for me to go out and talk to people about, money.
Right. And how much was that raise?
It's like $1 million.
Oh, okay.
Yeah.
Well, I mean, even $1 million for those days was still a lot, right? Like 20 years ago.
Right. So definitely, it could have been even 500, but I still would have been scared. I guess the third deal we did, I think we went from like $1 million and then the third deal was 4.8. So, and then the middle one was like 2.6 or something like that. So we went up kind of exponentially from the first one.
So what was some of, beyond the mental, what was some of the challenges that you ran into, in those first or those, few first raises?
For one, I think initially, people looked at me more as, a lot of people I knew that I actually try to raise capital from who were in IT business. And I was an IT guy, IT consultant. I think what helped a little bit was that I had bought properties previously, even though they were small properties. But that did help. But there's no question that people look at you as they tag you as a role. And then if you're now becoming a multifamily syndicator, how do you start going from one to the other is a struggle.
So how did you have those first, first few conversations? How did you introduce yourself and, share with your people what you are now doing? Yeah.
I told them that I had been buying real estate for, a number of years at the time. And it was, but I started to look at larger deals that I have invested passively in a couple of deals that had been going well. And then probably that helped a lot too. I had a partner that had more experience than myself at the time.
Mhm.
There's no question that helped to be able to rely on somebody else that was more experienced, gave credibility even to me because I was, partnered up with him.
Right. Which one do you think is more important? And I'm sure they're both important, but which one do you think is more important? Having a partner that has a lot more experience, or the fact that you also invested passively yourself?
The partner, for
Okay.
sure. Yeah.
Okay. Yeah.
I mean, investing passively, the one advantage to that though is that even if you're a passive investor, you're still a partner. So if you did a couple of deals and you invested passively in a few hundred units, you can say you're a partner because you are. If they said, "Are you a general partner?" I mean, you tell them, "No, I'm not." But I do think the partner aspect helped give credibility to me. Been there, kind of done that, and it helped kind of get us over the finish line.
Right. I like that. For some reason it didn't dawn on me to because I do quite a bit of passive investing myself. It just never dawned on me to call myself as a partner in the deal, but you're right. A limited partner is a partner.
You are,
Uh,
yes, for
you
sure.
know, yeah, that's good. I like that. So, so besides the track record, was there any other like big items that you see in, gaining the investor trust or yeah, anything else?
I don't remember exactly on that one, but I would say just as a general statement, being completely transparent about things. At that time, it was syndication, even though it had been around for a long time, was kind of newer in multifamily. People didn't know what questions to ask, things like that. But I think as a sponsor or general partner, you need to be, very open about what you feel maybe the risks potentially are in the deal as well. And you be, if there's something that if someone says, "Hey, I don't have any concerns over the project," then I probably wouldn't invest with them. I mean, every project has some sort of concerns that you're going to contend with, and just being open with that, and understanding that there are risks involved in it. People, there are no guarantees, and people say, "What's the worst thing that could happen?" Well, the worst thing that can happen is you lose all your money. That's a reality.
Right. Okay. So now let's fast forward a little bit. What has been some of your biggest raise that you've done? How much was the raise?
I think that probably the biggest we did was maybe 16 million in a
Okay.
deal.
And so what challenges did you run into there with a big raise like that you didn't run into with the smaller deals?
It seems like on the bigger deals, you get to a certain, I would never say it's easy to get to a certain number, but let's say I'm making it up. It's easy to get to 10 million. And then the last 6, you're just struggling, or if you're doing a $7 million raise, the first 5, you kind of get there in the last 2. But like the last, X percent, let's say 20% or so takes, it's 80-20 rule, right? That last 20% takes way more than 80% of your time to get to the finish line. But and we've had deals where we pushed out a lot of deals at once. So people are looking at, multiple deals all at the same time, 3 or 4 deals all being raised for, and, they get confused, or they start, they like one thing about one deal and something else about the other deal. So that can be, I don't really probably recommend doing that, we've had, I think 4 or 5 deals at once trying to raise all simultaneously.
Wow, that is, yeah, I can imagine how crazy that can get. I want to, about the 80-20 rule thing, how, 20%, the last 20% of your raise takes 80% of the time. Why do you think that is so? And how can is there something we can do to prevent that, or better prepare for it?
It's a good question. I think the easiest thing you can do to somewhat prevent it is to have people involved in your team that have already raised before. Not that I think they can raise. I mean, it's okay to have people like that too. And but people that have been there, done that, or if you have people that you're going to bring on, and if they're willing to commit a minimum. So let's say you're raising for a deal, and I'll say I think I can bring $500,000 to your deal, Tim. But if I can't bring it, I'll bring 250 myself, no matter what. Some sort of, I'd say guarantee that the person can contribute some sort of funds versus, a flat out 0.
Right.
So
Right.
having people that have been there, done that is critical. And then, part of it will be you kind of lose momentum sometimes, right? You lose, and people, uh, they'll look at something and then you might have to do another refresher webinar to try to get over that. Ideally, if you do another webinar for a deal, now I would say some cases it probably look great, but you might have to do that. But if you have more information to share, like, okay, since the last time we did a webinar, they've already been pushing around $75 a month. So the more positive you can share, or if you get closer to the end of the year, you can push out the depreciation benefits and things like that. People that they go the whole year without investing and they get to, October, November, they're like, oh my goodness, I need to invest some money to help with my taxes. But number one is getting people that have been able to raise before in the past on your team.
Gotcha. Okay. I know part of the Think Multifamily network, you encourage a lot of sort of co-GPs, fund of funds to come in, partner with each other. And, before coming into this industry, I didn't realize how much of that was happening in the industry. I thought that, whenever someone do a deal, the people that are coming on, that the people that are raising are typically an internal team. But then now that I've been in the industry long enough, I realize it's a very common practice that you partner with a number of other people, whether it's co-GPs or fund of funds that come in and raise with you. How did you have that idea to build Think Multifamily around that kind of concept? Because I think you're one of the few groups that make a really strong point around that.
I don't know if our intent was that initially, but I think as people, they meet each other at an event or on our calls and things like that, and kind of just hit it off, and then they want to partner up together. And then people that are newer, they don't really have typically the reputation in the marketplace to go get a deal. So what we just kind of found, or some people were like, well, I can't find a deal because I don't have the relationships that I need, but I can maybe bring some capital to the deal. And, as you mentioned, everyone should have a role, kind of going forward as well. The fund to fund is probably the cleanest way of doing it, for sure. But I would also say I would be, do deals, my personal opinion, that are manageable. Don't bring a bunch of people on that you don't know very well and things like that, because you don't know what they're doing. So I would limit the number of partners you have on a deal as much as you can, and within reason. Keep your rate a little bit lower because of that. Because you don't know, yes, you meet people, you develop a relationship, but you don't really necessarily know the capabilities or whether you mesh even from other aspects. But for us, it kind of just worked out where people, they wanted to find a way to get into a deal and bring in capital. We have a number of people that have their own capital, and then we'll give them part of the GP because the amount of capital that they're bringing individually themselves is very high. And there you can do that. There's really no SEC or anything around that because of the fact that it's just their own capital. They didn't raise it.
Right.
So that was one way to we've had some, various people with, a decent amount of capital come into deals and get part of the general partnership for that as well. And then the other one would be that, the TIC or tenant in common for 1031s. We've done that a number of times as well.
Gotcha. Yeah. So one of the things you mentioned is, making sure that the partners that you're bringing on. A lot of time people don't realize that whenever you are coming on as a co-GP, you're kind of married to this group of partners for the next, 5 years or so,
Right.
the life of the deal. What are some of the other risk or considerations that we should think about when recruiting others to partner with us? Or even on the other hand, consider us considering to come on someone else's deal as as a partner. What are some of the things we should consider or look for?
If you're coming on to somebody else's deal, I think one, you need to understand what, if any, control do you have. And it'll probably be none, most likely. Can you participate in asset management calls or at least listen to them? Yes or no. Everyone thinks it's a great idea to have all the people on the call, but some cases it's a distraction. So maybe they'll just record the calls and do it that way. The other one I would say is to understand how well capitalized the group is. So, right now times are a little tough, to be frank with you, on some deals. And do you have capital to put in the deals to help sustain them while you get over this, harder times right now? And if there's, people just scraping money together and they have none of their own money, then it can be a challenge. So having, someone or people in the group that can contribute some capital if needed first, and you explore that option. And then, but if it's where everybody's broke and then you're short on your mortgage, what do you do? We know what the options are, but and so that's probably when you're coming on to a deal, and then getting people into a deal to help you. I do think you mentioned it, you're going to be in it a long time. I think the personality is probably more important. I know it's business, but the personality conflicts, if you have reservations or you don't really get along, I wouldn't do business with someone like that, because you're not talking for a few months, you're talking for several years. So that's important as well.
So how can we best, when it comes to identify people, the lead sponsor team being well capitalized, how can we best determine that? And, in some cases where, they're a big operation, you can kind of tell, but is there a rule of thumb that you're looking for? Or can we just ask the lead sponsor directly, like, hey, how much, cash you guys have in reserve? What would happen if, if there was a capital call?
Ask that. Yeah, I think it's fine to ask that. I mean, they're not required to do it, right? A lot of syndicators wouldn't do that. I think if you're bringing somebody on, so kind of the reverse, it's fair to ask them, hey, if we needed funds for, operations, would you commit to putting, let's say back in minimum of whatever your acquisition fee was as a minimum, as a starting point. Because, we've done things like that. We've gone back to GPs, COVID GPs, and I can tell you it's crickets a lot. People don't want to put anything in, and it's a problem if they're not willing to do that.
Right. Yeah, that's good. So you mentioned it is a challenging time that we're in right now. A lot of deals, a lot of GPs, some are getting capital calls, and some even in much worse scenario as well. What are you seeing in the marketplace right now? And then where I'm leading with that conversation is, where do you see this market going? Like, how much longer do we need to, hang in there, make sure we don't run out of money, and benefit from when the market turns?
Yeah, I mean, we're very active in the market. We have some deals we're refinancing right now that will do decent. I think in some cases right now, if you can do a refinance, even it's a neutral refinance, actually it's a win, because most refinances right now will be a cash in refinance. So I'm seeing I think sellers are getting more realistic about what their properties are worth. They're going to be forced to sell. I mean, Treasury's gone up, SOFR's gone up, continue to go up. When it's going to stop, I don't know for sure, but that's causing definitely, some issues. The other one is most lenders are not willing to negotiate without you putting money into the deal. And then if you're familiar with the term kind of loan rebalancing, where lenders can usually set some sort of anniversary date, they can look at your loan and see if your debt coverage ratio is 1.25 or above, which, let's face it, 95% of every deal in the country right now can't meet that requirement as a general statement. They can do like a loan rebalancing. So last week, Tuesday, I spoke with a guy, syndicator. He has a $50 million loan on a deal, and he asked his lenders making him put $10.1 million into the deal.
Wow. How big is the deal?
It's a $50 million loan.
Oh, gotcha. Wow. Okay.
But this is nonstop right now, what's happening. And, in some cases, if the lenders aren't willing to work with you, which most of them don't seem to be willing to work with you, is a general statement right now. like you said, things will go back to the lender. I mean, there's really, if you're cash flow negative every month and you've gone back to, your GPs and investors, and you have the money you have to sustain, and it runs out, what do you do, right? Lenders just think there's an endless pot of money that everybody has to continue to sustain. So some people are just going to be like, hey, I'm just going to let it go back to the bank. There are some people, this concept of recapping a deal. Most of those funds that are recap funds really aren't really recap deals. They're really more interested in buying deals, which is fine. So we have some deals. We had a deal that we listed. Well, we got a BOV about 2 months ago, $18 million deal. And then we put it out on the market, and, we're getting into 16s for offers. So it's even in the last month, I'm not trying to be doom and gloom. Last month has got even, more challenging for a lot of people, and a lot of the bridge debt's coming due, and a lot of the floating, anyone on a floating rate debt right now without a rate cap can't survive. And even with a rate cap, in a lot of cases, can't survive. People have a notion that, oh, if the rate was 4.5, I'd have a rate cap. The rate cap protects me at 4.5. No, you might still be at, 7 or 8, but it's better than 12. So lots of deals been listed over the last couple of weeks. Markets are funky. I personally would probably shy away from a lot of the markets where there's huge, unknowns around insurance and things like that. And then we're, on top of everything else, we're in 14 states, and we have a couple of locations where evictions are still taking over 12 months to get people out. Wow. So I don't, how do you contend with rising, insurance, can't evict, interest rates going up? Some of those deals are tough to contend with.
Mm-hmm. Wow. Have you ever had a deal? Have you ever had a capital call on one of your deals before?
Not until this recently. Yeah. So we've done 120 deals, never had a capital call. We've done it more member loans. The main difference is, it's optional. You're not diluted if you don't participate. A lot of people would put it and you sit in front of all the other equity. Mm-hmm. But we also, I think as a syndicator, you have to make, in some cases, some hard decisions. So we have a deal, fortunately, that's going to do well, but I pretty much put all the money into that deal myself, and substantial amount of money, because we didn't know we didn't really know if we could believe in the deal. So if you don't believe in a deal, or the information you have today leads you to be, I don't know if it can work, you're going to have to make that hard decision and sell the property, most likely. Right. If you have a plan and it's like, hey, this looks good, you still have to be very clear with people. This is based on the data we have today. The risk is still there. The concept of throwing good money after bad, you could lose this money too. You could. I'm of the opinion, we did an idea recently, and it was member loans, and we did not actually take proceeds in. So I like the idea of doing a ballot first to gauge interest. Let's just say, for example, you have to raise $1 million, and you do the ballot, and most people do the ballot and wire me the funds. So you wire me in 20,000, a couple other people wire me in, so I have $100,000 out of $1 million, whatever we need. Well, and I'm going to use that money to sustain another month or two. I don't think that's right to those investors that participated. So I much rather we do a ballot, gauge interest based on the interest of the ballot, than move forward or not. And in this particular example, we decided not to ask anybody to wire in any funds at all.
I see. Okay. In terms of the conversations that, I know it's a difficult conversations that you have to have with your investors, but how do you have those difficult conversations? How do you break the news to them?
Yeah, I mean, I think the more time you can spend leading up to it. So, if it's just, we've had some asset managers that probably have not done a good job, probably communicating out kind of the real, everyone has this, concept, everything will be okay. Well, some cases won't be okay unless you take some action. So I think some investors have been surprised in some cases in that, but we have another deal where the asset managers have been phenomenal from the very beginning. I mean, like, just, awesome, communicating out everything, where it is, what could happen. I think, in some cases, you're going to have some investors, I talked to a guy, last week, and very apologetic, and things like that. He's like, I'm a big boy. I've been through this before, so you don't have to apologize, which I appreciated. And then you have, the other investors, that are, want to cuss you out up and down. And I get that. So I think the more sympathetic you can be to them, some investors are just like, well, you guys should put all the money in. All the GPs should just come up with the money. And it's like, well, we don't own the entire deal. So that would be like saying all the profits should go to us. You know what I mean? Kind of one of those things. But I think understanding how you got there is important. And there are a lot of things out of your control. And then you have the other aspect of it, it's okay to own up to things. Hey, we could have communicated better. We could have, but most of these things, unless someone's doing something completely like stealing and stuff like that, a lot of these things happening right now, if you want to say, are out of their control, which, for the most part, they are. I mean, insurance costs, we have a deal. This is a real example. Insurance went from $600,000 a year on a deal to $3.6 million in 1 year. Totally serious. Totally
Holy
serious.
cow. Whoa.
So we told the lender there's no way we can, that's not going to happen. So we still got it down, we got down to 1.2 if you want to say, but that's a perfect example of how would anyone predict that? And there's nobody on the planet that can make an extra $3 million expense work on any deal. So, but that's extreme. We have other properties that's gone up, 3 times in a year, insurance. But, investors think we should have been able to predict the future. We're not self-sabotaging our deals on purpose, right? And by having insurance go up. But I think being sympathetic, understanding, not getting, overly emotional about it, and, just saying, I understand. It's disappointing and all those things. But I think if you try to argue with somebody, if you're like, well, you signed the PPM document and the word risk is in there 61 times and the word loss is in there 69 times, and don't have those conversations. Are they in there? Yes. Are there a lot of things in there that say, that you want to say to the benefit of the syndicator? I'd say yes, but you don't really want to get back to those type of discussions. I think be sympathetic, understanding kind of how you got there. And then in some cases, you can spend all your time trying to figure out how you got someplace, but you need to, at some point, shift gears quickly and figure out how you're going to get out of the mess you're in.
Right. Gotcha. Yeah. Where's the light at the end of the tunnel here? What is your crystal ball telling you?
Every day is a new day, right? And every piece of data is new. My hope is, because of election year being next year, there will be some changes next year for rates. I've seen some projections that I think are probably not going to happen, as far as how low rates will go and things like that. And whether the Fed pushes it again, even this year. I hear things where some of the banks have been saying, or lenders have been saying, well, the pain isn't high enough yet. It's like, for who? They're definitely high for, you look at almost any industry, car business, real estate, all these, construction, they're all hurting, in a lot of respects. So I'm hopeful next year. I think the first half of next year is going to be pretty kind of like a bloodbath, frankly. So if you're, the argument could be, okay, all the things that got people into trouble, including us, what did we learn by that? What would we do differently? And where we put money? Because there should be some good deals next year. I personally think one of the best options, if you have an opportunity to do it, one, I'd look at loan assumptions is a good, good option for one. Or if you can get into fixed, But the other one, let's say, for example, you have a deal, Tim, it was a bridge debt, and you 70% occupied, now you're 90% occupied, and you have to do a cash in refi to get to Fannie or Freddie. So you need $2 million, but you fix your debt, you know how long it's for, you get interest only, all those things, right? And then I actually would prefer to invest in a deal like that, because there are way less unknowns on a deal that is existing. Let's say you own it for a year or two,
Right.
versus a brand new deal. What am I contending with? New insurance, I have no idea what's going to happen. Property tax increases, I have no idea what's going to happen. Can I get those rent projections I thought I was going to get? I have no idea if I can get those. Whereas a deal that's already existing, been around for a while, and if you want to say the only thing it needs is capital to do a cash in refi on permanent debt, I think that's probably the best investment people can make right now.
Gotcha. No, that makes a lot of sense for sure. All right, we'll switch gear a little bit around attracting passive investors. What are some of your favorite ways to market for high net worth investors?
Right. So my wife Camille does more of it. She does pretty much primarily all the marketing. But events, I know you're at an event right now. That's great. I think just being willing to talk to people that you meet. You never know who that, the first guy I ever bought some real estate from, he was in our hometown. He drove around in like a $800 car, wore clothes like, it's like, you just like you would not think the guy has any money, right? But he does. I think just being willing, treat everyone as equals. You never know who that, multi-millionaire, billionaire, whoever it is there. But also try to find things that you like. So, I don't, like a couple guys I know, I don't smoke cigars. I don't like them at all. But, they'll maybe hang out cigar place, right? Some of the guys I know have like boats. I don't like boats either, but I like cars. So maybe going to places like country clubs and things like that, buying a membership at a country club, hanging around people that have, certain things that have a lot of discretionary income, usually like boats, cars, things like that, are good places to hang out with. And then on the marketing piece of it, typically it's going to come down to giving some sort of content, free content to people. That's going to be primarily the way people are going to respond to you, and just being yourself. So can't tell you how many people are like, oh, you should do this, you should do that, you should act this way. It's like, I don't want to do that. I don't, that's not who I am. I'm exactly the same person everywhere, whether I'm at an event, on stage, or whatever. I'm the same person. So I don't think you need to pretend to be someone you're not. Doesn't mean you can't go out of your comfort zone or anything like that, but pretend to be something you're not, and just because somebody else is like that, I don't think it's a good approach. Just be genuine, be authentic, and then it's totally fine, in my opinion, to have conversations to build relationships versus like personal relationships versus business first. So if you have an interest in something, I talk to you about the interest, and I have the same interest or whatever it might be. It doesn't have to be yours. Like I've met a lot of people that they do like dirt bike riding, because my son does dirt bike riding. My daughter was doing dance, so those type of things I don't do, but I'm able to talk to people about that and show an interest in them, because people really want to do business with people that they like. They do.
Right.
So I heard one guy one time say, oh, I was at this event and these two guys were talking about baseball. How stupid is that? It's a real estate event. Well, they like baseball, maybe they're going to go to a baseball game together. So I think, just like I said, being genuine, being authentic, being yourself, building relationships, interest, trying to connect interest. I mean, people love talking about things that they like. There are only a few things I really like, unfortunately, but I like talking about them. Other things I could kind of care less talking about, but I can still talk to you about it if it's an interest that you have. My son's into music. I'm not into music, but I can always bring that up too. My son plays guitar, he plays drums, those things. So it doesn't have to be you personally that has that same connection, but trying to get as many connection points. Like I'm an identical twin, and I've had a lot of people reach out to me because I'm a twin and they're a twin, or where I've gone to school, people have reached out. So the more connection points, again, is going to be great. And don't worry about the business side initially. you truly try to build some of those relationships first, and hopefully you'll have lifelong friends because of it. There's a guy, I mean, I just had dinner with him Sundays for his birthday, and we met him at an event in Colorado, no joke. Attorney was there, I was there. We kind of hit it off with the guy. He lives in California, and he said, you know, my attorney said, man, you could have like a mansion in Dallas. He's like, oh, okay, you know, kid you not, within 2 days, this guy sent me an email, said, hey, I talked to my wife, we're thinking about moving to Dallas. 3 kids. He's been here 2 years now.
Wow.
And I mean, that's at an event. I spent about an hour talking to him. We actually went to a separate room. He kind of told me about his story, his life story, and things like that. But that never would happen if I was just all business. And now he's like one of my best friends, and we have a lot of things in common. So it's that's more important.
That's so cool. So, you know, along that line, if you know, I know you've raised over $100 million now. If you look at your investor base, is there a type of profession or a type of interest group that you find you have the more dominant of those type of groups than others within your passive investors network?
Profession group for sure. It's surprising to me a little bit, but it's the IT and engineers.
Ah,
and
so because they can connect to you, I guess, right?
Maybe, but I think it's pretty prevalent just across the industry. And I'd almost argue that, hey, those guys are so analytical. How are you going to convince them to invest at all, right?
Right.
They just analyze everything to death, but I think they understand it. And then we do have a number of like doctors and stuff that invest because they're so busy, you know, they just want to put their money someplace. But interest groups, there's nothing, I mean, other than real estate, right? There's not like a certain interest group I can think of that would be like, hey, if you go hang out here. I think hang out with people basically where there's money.
Gotcha. Yeah. And then, so do you, outside of real estate groups, do you hang out in other types of groups like, EO type groups to build relationship and raise money from?
Not really. We have before. Right now, no. We've looked at a number of like masterminds and things like that too. We've tried out a couple different venues, and maybe we're looking for something that doesn't exist. I don't know. I really don't know. But like I said, I do like cars, so my wife's like, you need to go start going to more car shows, stuff like that. But outside of that, that's about one of my few interests.
Right.
But there are people there that have a lot of money. Those shows.
Yeah, cars would be good too. I was actually here at this event. Jamil Jimmy, I don't know how he's more popular in the single family home space, but he was just sharing about, he bought a Rolls Royce, he put 60,000 down, he got like 150,000 in depreciation for it. So it's like, basically he's in it with no money, and then he put on Turo and make money from that. So it's just like how we do cost seg and bonus depreciation in the real estate space. So I'm assuming that there's probably a number of car guys that also have high tax burdens.
Yes.
That we can convert over to the real estate side.
For sure.
Yeah, that's good. So your wife handles all of the marketing. Which part of the business do you are you most focusing on?
Acquisitions, and then the coaching.
Gotcha.
side.
Gotcha. Okay, very cool. And in terms of like your investor relations, nurturing sequence and follow up, do you guys have either a digital newsletter, or do you have any physical newsletter that you send out to your investors?
Not really we used to do newsletter more regular. Now it's kind of ad hoc, but we do send content out to investors for sure.
Gotcha.
And then once they come in, they'll kind of get into a nurture sequence, and then they'll, depending on what their interest is, they'll typically see something different based on what path they're going.
Right. Okay. And then I know you guys also do a lot of events as well. Also attract a lot of passive investors from your events that you host?
We do. Yeah,
That's
our events aren't necessarily geared just for passive, but there'll be a number of passive investors there for sure.
right. That's good. Yeah. I'm kind of following that path right now. I've done 2 live events already. I've been in this industry now for 16 months.
Oh,
I'm
wow.
counting by months, but I've done 2 live events already, and it's
Awesome.
growing. Yeah.
Great.
So thank you. Yeah. Yeah. So what are some of your favorite tools that you guys use in your business?
I mean, for me, since I do a lot of deal analysis, we have our analyzer we built ourselves. We spent a lot of time and money and everything else on that, but I use that. I mean, that's one of my primary tools for analyzing deals. And then we have some, asset management tools that our asset manager director kind of built, if you want to say. So that's been beneficial for sure. My wife, Tamil, focuses more on, click funnels and active campaign and things of that, CRM type stuff and nurturing sequences and stuff like that. But those are primarily, what we deal with. So I mean, a lot of my stuff actually is Excel, just is.
I see.
Yeah.
Very cool. So is it just the 2 of you are the main partners, and then when you're doing deals, you bring other partners on the deal, but they're deal specific partners? Is that correct? The core business is just you and Tamil?
Well, we started it, but we have like IT and we had a marketing guy and executive admin and, but as far as for deals, we're the 2 owners of Think Multifamily, and there are people that support that. And then what we do bring on different people, like you mentioned, for deal specific roles.
If you wouldn't partner with your wife, if you were coming into this business, let's say it's just you, is there a organizational structure that you would recommend? It's like, okay, you should have 2 partners, 3 partners, like, or you need to have a person for these 3 key positions. Do you have anything like that you found that works really well for our industry?
I think depending on how many people you need to fulfill these roles, but you need someone for acquisitions, someone for capital, and then you need a full-time asset manager, in my opinion. I mean, I guess if you didn't have enough deals, but the concept of using asset managers, which we've done before, that they're also syndicators. They go find deals, they raise capital. That's not my personal opinion, that has not been a great story for success. Because it's too time consuming to do those other things. So I would make sure that somebody that is overseeing the assets from an operational standpoint, not that they're just a good person and they're smart, they have to have experience in that ahead of time. So if you need to hire that out so you guys can learn or whatever, I would do that. But that's so critical. So again,
yeah.
people to acquire, raise money, and then asset management.
Okay. Yeah, and I'm just thinking from a personality perspective too. Like the person that is good at going out there and hunt deal is a different personality than the person who optimize things, right? Like, and when I think of asset management, I'm thinking like this is someone who loves to dig into the details and optimize like every little piece of it. Is that about right? I'm like thinking.
Oh, for sure. Then basically know yourself, right? You know yourself. Don't try to conform to a role because you just think it's whatever, it's going to be more fruitful money wise. If you're not a detail oriented person, like I have an identical twin brother that does asset management. I mean, we're born 12 months away from each other, right? But we're very different in a lot of respects. He's way more detail oriented. We're both CPAs, but he's like another level as far as his level of, if you want to say being anal of all things, but he is. And I could potentially convince myself that I could do that, but it's not a good use of my time.
Gotcha. Yeah, very cool. Well, Mark, it's been an honor and a huge blessing to have you on the show with us today. For the folks that are listening and want to reach out to you, connect with you, learn from you, invest with you, where would you like to send them?
They can just email me. It's Mark, M-A-R-K, at think, which is T-H-I-N-K, multifamily.com.
All right, Mark at thinkmultifamily.com. Awesome. Any last words of wisdom you'd like to leave with us all with today, especially, the people who perhaps at earlier on in their capital raising and they don't, they had that mental block that you did. Anything at all that you'd like to leave us with today?
It's okay to go slow, and it's okay to start a little smaller. We've always pushed going big, but it's easier to cover a $10,000-$20,000 shortage a month versus a $200,000 shortage a month. So, like I said, it's okay to go slow, and I think in some respects, it's okay to do different types of deals, but as much as possible, make sure you do have cash flowing deals. We've done a lot of distressed deals and done really, really well on all the deals we have. But we also, during that market cycle, it was very, very good. So I think making sure that the deals can cash flow kind of as is without really, adding a lot to it, because we've had properties where we have, right before COVID, bought the properties, going to re-tenant it and re-renovate it. And COVID hit, we couldn't kick people out and we couldn't renovate. That's a problem. So the business plan should hopefully work regardless of whether you can execute on the full business plan or not.
I see. Okay, awesome. Mark, again, thank you so much for doing this interview with me. You've been sharing with us a lot of great wisdom. And so thank you so much.
For sure. Thanks for having me. I definitely don't want people to have to go through some of the pain we've gone through. Actually, I don't. So, yeah.
Awesome.